Thank you very much for joining the 2022 interim results presentation for Quixant PLC. I'm just going to start, for any of those of you that are watching that haven't come across the business before, to very briefly describe what we do. So Quixant is a technology outsource partner, and we work with our customers, which are the manufacturers of electronic equipment, to support them in providing outsourced solutions for key part of their technology requirements. And we do that by focusing on specific vertical markets. Over the business, we have several different engineering disciplines covered: hardware, software, displays, and mechanical engineering. And we have that covered via a global team of engineering capability, spanning from the west coast of the US as far as Japan in the Far East. The first market we identified to bring this business model to was the casino gaming market. And what we brought to that market was a bespoke computer platform, which combined hardware and software elements that allowed the manufacturers of casino gaming machines to outsource their computer design to us. And through doing that, what it enabled them to do is to focus a greater amount of their R&D on game design, which is the key commercial differentiator of the slot machine from their competitors. We then went on in 2015 to acquire Densitron. Densitron has a 52-year pedigree in supplying industrial display products. And through that business, we execute our strategy to diversify into new focus sectors and move up the value chain in those markets. We've got an IP-rich portfolio with patents granted. We've got about 230 employees globally and operations in 9 countries and customers in 50, so a very global business at its heart. And we've had a historic double-digit CAGR growth track record up to the full year results last year. So just briefly on gaming, I talked about gaming being an offering which allows customers to focus increasingly on software. So game software, the game itself, is what players play a machine for. And you can see on this slide that in the past, before Quixant came along, the gaming machine manufacturers were still spending significant amounts on the computer platform and the cabinet design, leaving less budget available for game development. Well, we leveled the scorecard so that game development takes the lion's share of their investment. And that means that they can have, hopefully, a better chance of writing good games that the players will enjoy playing. You can see our slot machine deployment on the orange box on the left-hand side. The market overall is addressable is over $1 billion on a very global basis. And there's a handful of sort of large companies, some of which are public within that. The overall, the global slot machine install base is about 9 million units, with typically a 4 to 5% annual replacement cycle before the pandemic. And that reflected about 400,000 odd machines per year being replaced. So that's our directly addressable market for our computer platform products. Average video slot lifetime is 3 to 5 years. Outside of that 3 to 5 years, there's a much bigger block of old, what were called colloquially one-arm bandits, which were not video based, and those have a much longer lifetime than that 3 to 5 years for a video slot. Just onto Densitron. So Densitron is a display components business initially, and you can see that on the left-hand side, these display components find their way into many different industrial equipment used in global machines. But over time, what we've been doing with Densitron is moving it into a business supplying higher value products. The control surfaces, where we add computing into it as people need to add touchscreen type technology to their equipment. The addition of computer technology means that we can enable them to make those touchscreens easy to adopt. And then finally, by adding software onto the mix, we can add a sort of a full turnkey offering for controlling of equipment. And the first market where we've seen this opportunity to leverage the group's engineering expertise is the broadcast market. And what we're helping customers to do is to move from this mechanical control of broadcast equipment up to touchscreen based control, and in doing so migrate up the value chain within that market and grow that business at double digits. So hopefully that's a good idea of what the company does. I'm going to move on to now how we've been performing over the first half of the year. So first half of the year, we're really pleased with how the period's gone. We had a good end to 2021, and that's continued in the first half of 2022. So we've seen continued buoyant demand across all our markets, and that's signified by order intake being ahead of current year revenues and indeed ahead of prior year order intake in the first half. And that is on top of a significant growth in gaming revenues and in Densitron revenues, gaming being back towards pre-pandemic levels and Densitron achieving the highest ever 6-month period since acquisition. So very strong revenue performance, and also pleasingly to see it better gross margins. So we've seen somewhat of a recovery in gross margins. We issued several price rises to customers last year to push through the component cost inflation we were seeing. And as we've seen the component prices leveling off in the first half of 2022, those price rises we enacted to customers have started to show some recovery in our gross margins. And that is combined with higher production volumes in our manufacturing, driving operational leverage and pushing up our margins. Supply chain has been, I'm sure you're aware, an extremely difficult time, particularly in the electronics sector. And we took early action proactively to buy strategic stock in 2021. And whilst that's resulted in an outflow of cash from operations, it's meant that we've managed through our supply chain risk very well and enabled us to continue to deliver those strong trading performances that I've talked about. And we've also, as one of our key strategic pillars, aimed to diversify our business and move up the value curve within those sectors. And within gaming, we've made good progress within that by converting the first production order for our cabinet solutions, which allow the customers to buy more from Quixant than just a computer board, but buy full turnkey cabinets. And that order is valued at $4 million and is due for delivery partly in Q4 this year and into 2023. So really strong period of trading performance, and we're very pleased where we're positioned coming into the second half. And with that, I'm going to hand over to Johan, who's going to take you through some more of the financials.
Thanks, Jon, and good morning, everyone. As we move to slide 8, we see the group financial highlights for the first half of 2022 compared with the first half of last year. And as Jon said, a really good first half for the group. Revenue of 53 million, up 46% on the first half of last year, and also sequentially up on the second half of last year. The recovery in gross margin to 31.6%, up 130 basis points from the first half of last year. And the higher revenue and improved gross margin meant that we could grow both profit before tax and EPS by triple digit to 3.5 million and 4.1 cents respectively. We have seen an outflow of operating cash flow in the first half. This has principally been the investment in working capital that we've made to secure critical components to be able to meet the current demand of our customers and also build for future growth. At the end of June, the group still had net cash of $12 million, so good operational liquidity to fund further growth. As we move on to slide 9, which shows the group revenue performance by half year going back to 2018. And as you can see there, continued recovery, the fourth consecutive half year of growth from the impact of the pandemic, with the group now consistently getting back to the pre-pandemic levels, revenue of 53 million in the first half. What's particularly pleasing about this is it's been broad, consistent growth across both businesses and aligned with our strategy. We're building a more diversified, stronger business. And one of the metrics of that is our revenue concentration. If you look at the graph on the bottom left, that shows revenue from our top 10 customers as a percentage of our overall revenue. And we've broadly a similar revenue concentration in the first half of the year, but still improved compared to pre-pandemic due to a higher Densitron contribution and also continued diversification within the gaming customer base. As we move to the next slide, this just shows revenue by our two divisions, starting with the gaming on the left. And again, you can see there the recovery from the pandemic. Revenues up 71% year over year in the first half, and also up 9% compared to the second half of last year, driven really by buoyant customer demand. Order intake has continued to be very strong, ahead of revenues and ahead of the prior year. We've also seen resilient management of our supply chains, which has meant that we've been able to deliver our components to our customers and ship 22,500 platforms in the first half of the year, 45% up on the first half of last year, and the highest first half since 2018. Moving on to Densitron on the right, another very strong first half, a new high of 21.9 million, improving on the second half of last year and also being 21% higher than the first half of last year. This again has been broad-based across all of the Densitron subsectors, including broadcast, which grew by 43% year over year. Moving on to gross margin, And as Jon said, gross margins up. We started seeing the recovery in gross margins up 130 basis points from the first half of the year and 230 basis points from the second half of last year to 31.6% in H1. The margin recovery really reflects a combination of factors. Firstly, we're seeing a leveling off in component pricing, allowing the effect of the price rises that we put through in 2021 and early 2022 to start to positively impact margins. We've also benefited from the higher proportion of gaming revenues, up from 50% in the first half last year to 59% in the first half of this year. And then finally, with the overall higher revenues the group are delivering, that improves our operational leverage, leading to lower cost of manufacturing. So it's really the combination of these factors driving the recovery in margin. And this recovery has been delivered despite what is continued to be a challenging supply chain environment, particularly with freight costs still at elevated levels when compared to pre-pandemic. But we have taken action to recharge more of these from our customers. Moving on to our profit before tax, $3.5 million of profit before tax delivered in the first half of the year, nearly 3 times the level of the first half of last year, primarily driven by the higher sales volume. So sales at 2021 margins adding $5.1 million to our profit line, the improved margin adding a further $600,000. We have seen an increase in our operating expenses of $3.1 million. This has been largely due to investment in headcount as we've supported the existing performance and also the future growth of the business by adding to our sales and product development headcount. We've also experienced the impact of cost inflation in our operating expenses, most significantly in wage inflation. We've tried to balance the need to retain top talent with the wage inflation by focusing the salary increases on increasing the variable pay structures and share-based payment compensation. Looking ahead to the second half of the year, we expect that cost inflation will continue to impact our operating expenses. But despite the effects of inflation, we expect to improve on our profit margins from the 6.5% that we delivered in the first half of the year. We expect margins to approach double digits in the second half of the year, with this upward trend expected to continue. Finally, just looking at our cash performance, this graph shows the movement of net cash in the first half of the year. $12 million at the end of June, decrease of $5.6 million, primarily due to the investment in working capital as we've invested in stock to secure key components to be able to deliver to our customers. And without the investment in stock, we would not have been able to deliver the growth in revenues that we have in the first half and continue to deliver to our customers. In addition to the working capital investment, we've also continued to invest in new product development with $1.2 million capitalized in the first half, and we've also made tax, interest, and lease payments of $1.6 million. Looking ahead to the second half of the year, we expect further cash outflow in the second half due to the dividend payment of $1.9 million that we made in August, and also as we expect that working capital would need to stay at these elevated levels due to what remains a volatile supply chain environment. But looking ahead to 2023, we expect working capital to unwind in line with improving supply chains. And with that, I'll hand back to Jon.
Thanks, Johan. So let's just dig into gaming a bit and learn a bit about what's going on in the underlying market. So one of the things that gives us a great degree of confidence that we have a strong growth opportunity ahead of us in the business is the underlying casino market is very strong. So this is the market that our customers are operating in. And what we see in the really important US market, where around 60% of our business comes from, is over 2021 and into 2022, you're seeing record levels of land-based casino revenues being reported in the North American market. So that sort of level of strong market demand for gaming machines is one of the things that has been surprising in how quickly it's recovered and how resilient it is after the pandemic. So in America, you saw a real V-shaped recovery in land-based revenues and now continuing to report revenues at record levels. Europe's a slightly slower recovery, so principally because many of the European countries had more stringent measures on COVID for longer. You didn't see that stark improvement in 21, but the European Gaming and Betting Association is assuming a significant improvement in 2022, and you can see that characterized in the chart on the slide here. and then thereafter going on sort of a gradual single-digit growth in land-based revenues. Asian markets, so particularly the Macau market, remained heavily subdued due to COVID restrictions. The Macau market in particular is not particularly critical for Quixant's direct opportunity, principally because it's got a very small number of slot machines deployed in the market. It's more of a table games market, so represents a small proportion of our addressable market. But overall, the gaming market itself, and particularly the North American market, is very healthy, and we see the end market as being compelling for our customers to continue to deploy new machines into, and therefore for us to be deploying more of our computer board solutions and cabinet solutions into those customers. And also that we are continuing our journey of further penetrating more new business in those customers. So overall, we don't need a growing gaming market for Quixant to be successful in growth. It's about penetrating more business and convincing more customers to outsource to us. The gaming cabinet offering is something that we've been working on very hard for a number of years now, since 2019 actually, where we first launched our self-service betting terminal for the sports betting market. And I'm really pleased to say last week we announced that we had won our first mass production order worth $4 million for a new customer for the electronic gaming machine cabinet that you see on the left-hand side of this slide. The gaming cabinet offering executes one of our key growth pillars, which is to increase our share of the customer wallet. So by supplying computer boards to these customers, we can earn a certain addressable market. By supplying the whole cabinet, that increases the area of the addressable market we're supplying into. And also in the current market climate, full turnkey hardware offerings are ever more valuable to customers as they focus increasingly on just the software element of their machines. And by doing that whole turnkey cabinet, we enable the typically smaller customers who are targeting lower cost gaming markets to extensively outsource their hardware and software and focus entirely on software development. So a really exciting evolution in gaming cabinets, and something that we believe will deliver continued revenue growth in years to come. So on to Densitron, and what's really pleasing within the results we announced in April this year for last year, and also in this round of results, is Densitron's continued its trajectory of beating records. And in the first half of this year, it improved on a previous high in the second half of 21 to grow to another record period of trading in the first half of 2022. And that builds on a resilient trading period through the pandemic. So whereas the gaming business was affected by the closures of casinos through 2020, Densitron really traded very resiliently through that downturn and continued to support the group's financials. Part of the reason why we're seeing this ongoing growth is broadcast, our second focus vertical after gaming, has delivered another period of double-digit growth, so increasing 43% in the first half compared to the prior year. We've also made some important key hires as part of the investments that Johan highlighted in Q3, including the introduction of a senior product specialist from Grass Valley and a broadcast sales leader. So significant, important hires for us within Densitron Broadcast that we believe will be critical to the ongoing growth and conversion of new business within that sector. And we also announced in August that we'll be launching a cloud deployment of IDS, which has previously been deployed in some very high profile broadcast corporations as an on-premise solution. Now you'll be able to get it as a cloud deployment offered on a SaaS basis, and that reduces the capital intensity for customers looking to deploy IDS and allows them to convert that capital investment into an OPEX type investment and make it more flexible for them to deploy upgrades, etc. So excited to be launching that at the IBC show, which takes place this week. And then the other part of the growth we're seeing in Densitron is just because we've been doing a lot of work over the period since we bought the business in 2015 to transform the company's display components business, the part of the business that's been operating for 52 years. And there's sort of a host of different things on this slide that we've been working on, improving the supply chains and moving it all into Asia, reorganizing the regional teams to improve on their focus in sales growth. We've terminated some non-performing business units and rationalized product offerings, and brought a greater degree of KPI-led management. And overall, what we believe is this has led to a sort of a structural improvement in our fortunes in the Densitron display components business. And particularly at the moment, we think that the investments that we've made into inventory has given us a competitive advantage and allowed us to win new business in what is a very competitive market. So we believe that these actions overall in the long term can deliver the sustainable single-digit growth from the Densitron core display components business. And that then sits alongside the double-digit growth that we see from the focus markets such as broadcast. So an exciting time for us, we believe, in Densitron, and sort of the turning of a corner for that business to a future exciting growth story. So just onto the group, and I just want to sort of highlight or reiterate some of the group growth drivers that we have. So the first is we seek an objective to identify target vertical markets where we can supply a product into that market which is not currently offered in general technology solutions. And we then try and allow the customers to outsource that part of their infrastructure to us. And within that, we've made good progress in the first 6 months this year because we've delivered another double-digit period of broadcast market growth, which is our second target vertical market. We've also, as an objective, got a target of identifying new customers within that market and really understanding at a very grassroots level what those customers need. And we've also had successful conversion of a new customer in gaming cabinets and pipeline progression within gaming boards and broadcast as well. So successful progress on that objective from the group's growth strategy. We've successfully increased our share of the customer wallet, so by announcing our first gaming cabinet mass production order, and continue to invest to move up the value chain in products such as Tactilla, which is a tactile touch technology that's used for the broadcast market. And we continue to have a robust balance sheet. So as we see strategic acquisitions that are compelling to add technology capabilities, we have a position where we could move forward on deal flow of that ilk. So just in terms of outlook, we are extremely confident in the business's growth ahead of it. So we have an ongoing strength of broad-based order intake, and that gives us confidence that there is significant growth available in high quality revenues. Our product offering, brand strength have been, if nothing else, improved during the last period as we've helped our customers through a difficult time, and we've had greater stock available because of our investments into strategic stock, and that's driving increased customer momentum. And so whilst there is ongoing macroeconomic uncertainty and we don't expect supply chain challenges to ease immediately, we believe we have got good experience in tackling those issues, and we believe that means that whilst we continue to have demand which is tempered by supply, we believe that we can take advantage of the buoyant market demand as we go forward. So supported by a strong start to the second half and excellent order coverage, we're very, very confident achieving the recently upgraded 22 expectations for revenue and profit, and believe in the longer term, through disciplined execution of the growth strategy that I outlined, we have compelling opportunities for long-term, high-quality, sustainable growth. That's the presentation. I'd be very happy to take any questions.
And we've got a question from James Wood from Canaccord.
Two questions from me. Both kind of relating to turnkey cabinets, I guess, in one way or another. The first is more to do with the sales cycle and whether the sales cycle for turnkey cabinets differs from that relative to, you know, the standard platform offering. Also, there's a similar regulatory environment with regards to the bill of materials on that. And then the second question is to do with working capital intensity. Obviously, investment in stocks being a key driver of the success of late. And I wondered what a normalised profile is going to look like going forward, especially if you continue to build out the cabinet business.
Okay, thanks, James. Yeah, I'll pick up the first one, and Johan, maybe you could pick up the second one. So, just on the first point, the gaming cabinet sales cycle, I think, is very similar to the computer board sales cycle, principally because the end offer is exactly the same. So, whilst you know, perhaps in gaming cabinets, because we're targeting some of the smaller customers, there may be a degree to which you can win the business quicker. I think that the ultimate conversion of lead through to mass production sales is about the same, because you still have the customer's integration effort to put their software onto our gaming hardware. You then have the regulatory approvals to seek. So I don't see a radically different sales cycle compared to the gaming computer board. So it is, you know, a relatively long gestation period, although I think because we're doing more of it, they haven't got to investigate mechanical compatibility between the computer boards and their own cabinets, because we're designing that whole piece for them. Perhaps the conversion of the lead to confirm new business may be a bit quicker.
Yes, and then just on the second one, James, in terms of the process with working capital for the cabinets, it's really similar to the rest of our gaming computer boards. And so there shouldn't be a change in the working capital profile or in terms of the investment because of the cabinets versus our more traditional business. And it's also, we have the same challenges around this. So it's going to be the working capital profile will change just in line with how the broader market normalizes.
I think it's fair to say, James, on the overall supply issues, we do that they will ease. There's the $1 million question of when. Literally $1 million question of when they ease, but they will ease, and as they do ease, we have the ability to reduce our inventories from the current levels. So we don't see that structurally our group inventory needs to remain at this level on an ongoing basis, but clearly underpinning customer demand and trying to protect customers from supply chain stoppages, which has been our central objective throughout this period, is the most important thing we can do. So utilizing working capital to enable that has been our preferred approach. But as soon as we start to see some confidence that there is going to be an easing of components, and bear in mind, it's any component in our design that could stop the production. So we need to be very careful about sort of being blasé about some areas of the market easing, because if others aren't, we could catch a cold. So we have to make sure we safeguard supply chains first and foremost, and as they ease, we expect to see a reduction in working capital intensity.
And we'll go to Jon Jayal from FinCap.
Quick follow-up on James's question on the cabinet. One of the points that was made about the turnkey solution is that you would be able to make a difference in terms of the designing, for example, a better heat diffusion than they've had in the past. Have you been able to institute that in this first order? Will it differ? Will people look at this order and say, this is a better way to do it? Have you been able to make a difference, or will that happen as we go forward in terms of cabinet designs?
Yeah, so we have taken into account a lot of things that we've learned. We've learned lots from looking at customers' deployments of our computer boards, and so yes, we have implemented some of that. Of course, engineering is always about ongoing continuous improvement. So there are things that we also will continue to enhance as next generations of the product come out. But we've built this cabinet from scratch. It's been a ground-up design, and therefore in that comes lots of flexibility around making decisions that mean that on long-term your offering is dealing with things like thermals, which are an ongoing issue for cabinets, and particularly thermals related to the sort of preventative maintenance, as it's called. So cleaning out dust filters, for example, which get very clogged up. If you make that easy to do, the casinos are more likely to do them. So we've thought a lot about how we make the cabinets easy to maintain by the casinos, and therefore less likely to fail in the field. Dust is a real problem in many of the locations where machines are installed. It's a dusty environment. It can be in things like the desert, where you get a lot of sand coming in. So we need to try and make ways in which the cabinets are resilient to that, and therefore have a longer shelf life.
So it's safe to say that as these units go out there, people will start taking a look at that and will generate further interest on the back of that.
Yeah, and I think it's fair to say, we've talked a lot. I mean, we work with our customers anyway, that design their own cabinets on thermal design, because obviously, we have a vested interest in making sure that our boards are installed in the right locations, that they haven't got any of the vents blocked. You've had things in the past where, for example, you've had the tickets that are used for ticket in, ticket out being stored on top of our products, and that blocks fan vents. So things like that we've tried to to sort of support in the integration efforts, and that's really the part of the partnership that we offer. It's not just about supplying them a board and that's the end of it. We want to make sure that board then works for them for 5 years in the field. So I wouldn't say that everything we've done is unique in our offering. I think it's something that we've tried to build all of what we've learned into our offering, but certainly our customers are very proficient at designing cabinets which take into account many of those characteristics.
And we'll go to Hayley Palmer at Canaccord.
I just had a quick question on the price rises and the gross margin impact. And I was just wondering, as the component prices level out and then maybe return to more normalized levels, might that create some risk to an unwind of the price increases that you've put through to customers? And then would there be kind of an associated impact on the gross margin on the other side of that?
Yeah, so it's a great question. So, look, we've said, time and time again, we're not looking to profiteer out of the inflation that we've passed through to customers. So we have done several rounds of price increases. In fact, it's sort of evident in our P&L that it's hit us because we haven't done it fast enough or greatly enough through 2021. So we're not looking to profiteer out of the price increases that we've effected to customers. And so, as we start to see prices easing on the component side, we are going to look to offer customers, a reduction in their sale prices. It would only be fair to do so. So that the pace at which that happens, will be dependent on, the pace at which we see components easing off. We're not looking to sort of give discounts because there are rumours of easing of the market pricing. We haven't seen that bill of materials cost easing yet. We've seen it levelling, so it's not continuing to go up. But we will look to offer some discounts to customers as the market starts to ease and component prices go down. And ultimately, that's why our business objective is about increasing the value of our product offerings. So within the Densitron business in broadcast, we're looking to increase the value of the products we're offering, because that's how we earn enhanced margins, through earning it with products which are worthy of those margins, not by profiteering out of market dislocations on pricing.
And we've got a question from Robert Sanders at Shorecap.
Just on the dollar and trying to gauge what the move in the last 6 months has done in terms of to the business, and more importantly, what's going to happen as we move into the next year. Is it a tailwind? Is it a headwind? How do you go about forecasting what the dollar is going to do?
Yeah, and it's probably good for you to pick up.
Yeah. In terms of what the dollar is going to do, I think it's at the moment maybe it's what the pound's going to do against the dollar, which has been difficult to forecast. I think in terms of our exposure to the dollar, most of our more than 90% of our sales are in dollars. So the dollar movement doesn't really impact our sales price, and we also buy most of our components in dollars. It's really just our operating expenses with our cost base in the UK and in Europe, which is impacted by the dollar. So the strengthening dollar will help us from an overall operating expenses perspective. And so we've taken out hedges in the past to hedge against the movement in the dollar, but for the most part, it's just managing the costs, and then keeping a close eye on the FX movements.
And we'll go to William Larwood at Liberum.
First question for me is just sort of on the sort of margin differential between sort of the turnkey cabinet sales and your sort of existing computer board devices. So, as that portion grows over time, is there a margin benefit there? And then the second one is, what are your thoughts on sort of M&A at the moment? Are you looking at any opportunities in other sort of subsectors?
So on the first point, the gaming cabinets, sort of probably unsurprisingly, there's a big lump of metal that we're supplying as part of that offering. And those gaming cabinets are an important sort of route to market for our computer board. So the overall gaming cabinet revenue, overall gaming cabinet margins, we expect to be somewhat lower than the computer board margins, although still from a sort of an overall group point of view, still compelling to target, and certainly not dilutive to where the group margin is today. So gaming cabinets nonetheless add value to the mix, and so they'll be priced accordingly for that value that we're offering in terms of the full supply chain outsourced to us. In terms of M&A, it is very much part of our business strategy. We've undertaken M&A in the past on a number of occasions now, and clearly for For a couple of years now, we've been focusing on our knitting and trying to keep the business that we've got ticking along and looking after our customers' demand. But we are looking for ongoing new deals. Our balance sheet is strong, which enables us to take advantage of opportunities that arise. And where we see technology companies or bolt-ons which would enable our acceleration of our growth strategy, we would look to take advantage of those through acquisitive means.
And that is the end of questions. Jon, do you have any closing remarks?
Thanks, Tamsin. So overall, we are extremely confident, as you can probably gather, in our outlook for the second half of the year. Order coverage excellent and supported by good trading in the half to date. And that means that we believe that the upgraded expectations for the business for the second half are very achievable. And we're confident of getting to those numbers. And thereafter, we see excellent order intake, which means that for the year ahead, we also have good confidence of an ongoing growth story. And the longer term outlook for the business through this execution of the growth strategy means that we believe the company can deliver a high quality, sustainable growth in the years to come.